Welcome back to Economy Quotient. Now imagine this for a second. In 2008, the world learned the hard way what happens when too much risky debt gets packaged, hidden, and treated like it's no big deal. This time, the danger may not be sitting in suburban mortgages. It may be hiding inside private credit, a giant, fast-growing corner of finance that most normal people have never even heard of. And that is exactly what makes it interesting and dangerous. So today, let's break this down in plain English. What is private credit? Why has it exploded? Why are big investors suddenly getting nervous? And could this really become the next financial crisis? Let's start simple. Private credit is basically lending that happens outside traditional banks and outside normal public bond markets. So instead of a company going to a bank for a loan or issuing bonds for everyone to buy in the public market, it goes to a private lender, usually a fund, an asset manager, or a big pool of private capital, and the deal is negotiated directly behind closed doors. Think of it like this. A bank is like a fast food chain. Everything is standardized. The menu is fixed. The process is predictable. Private credit is more like a custom chef. The loan can be shaped however the borrower wants, which sounds great until you realize custom deals are usually harder to compare, harder to value, and much harder for outsiders to understand. And that is one reason private credit grew so fast. Over the last couple of decades, the banking world changed a lot. The number of FDIC-insured banks in the United States nearly halved between 2002 and 2022, and the system became much more consolidated. Bigger banks focused more on scalable, repeatable products. Mortgages, credit cards, big corporate lending, things that fit neatly into giant systems. That left a gap for medium-sized companies that still needed financing but didn't fit the neat little boxes. Private lenders jumped right into that gap, and wow, did they grow. The IMF said the private credit market topped about $2.1 trillion globally in assets and committed capital, with about three-quarters of it in the United States. The Fed has also noted how quickly private credit has grown to the point where it now makes up about 7% of total outstanding non-financial corporate debt. So this is not some tiny niche anymore. This is a very real, very large pool of money. Now, here's where things get spicy. Private credit on its own is already a big story. But the real drama starts when private credit mixes with private equity. Private equity firms raise money from investors, then borrow even more, buy companies, cut costs, try to grow profits, and later sell those companies for a higher price. In theory, that sounds clever. In practice, it often becomes a giant leverage machine. Investor money is used as the base, then more debt gets layered on top, then the company being bought carries even more debt, and suddenly you're looking at a financial Jenga tower built out of borrowed money. That is why people say this system is debt on debt on debt. And for years it worked. Why? Because money kept flowing in. Private credit funds were offering attractive returns, private equity firms kept doing deals, companies kept getting refinanced, and many exits were basically one private equity firm selling to another private equity firm. It started to look less like building real value and more like investors passing the same expensive parcel around the room and praying the music never stops. But now the music is wobbling. One of the biggest problems is interest rates. When rates were near zero, almost any risky loan could look clever because safe alternatives paid almost nothing. But when government bonds can offer decent yields again, suddenly a risky 9% loan to a highly leveraged mid-sized company does not feel nearly as magical. On top of that, many of these borrowers are dealing with floating rate debt, which means their interest costs rose when rates rose. So the same company that could survive in a cheap money world now has to run faster just to stay alive. The Fed has warned that many private firms already have weaker debt servicing capacity, and for private credit borrowers, the average interest coverage at issuance has been around 2 or even below that range, which is not exactly a giant safety cushion. In plain English, many of these companies do not have much room for error, and we are already seeing cracks. Fitch said the U.S. private credit default rate continued rising into January 2026, reaching 5.8%, while default pressure in the riskier part of the market more than doubled from a year earlier. That does not automatically mean disaster tomorrow morning, but it does tell us the quality trend is moving in the wrong direction. At the same time, some of the biggest names in the industry are suddenly having to slow down investor withdrawals. BlackRock restricted withdrawals from its HPS corporate lending fund after investors asked to pull out $1.2 billion in the first quarter, about 9.3% of the fund's net asset value. But the fund only returned $620 million because of its 5% quarterly limit. And it is not just BlackRock. Reuters reported that firms like Morgan Stanley, Apollo, Ares, and even Blackstone have all had to manage elevated redemption pressure in private credit vehicles during March 2026. That is the kind of thing that makes markets stop smiling and start sweating. Now, here's the part most people miss. This is not just a Wall Street story. These loans often sit behind real businesses, not meme coins, not fake internet magic. Actual companies with staff, payrolls, inventories, rent, software subscriptions, warehouses, and customers. So if these companies get squeezed by higher interest costs, slower demand, weaker margins, or tariff and market shocks, they do what struggling businesses always do. They cut spending, freeze hiring, and lay people off. And then the problem feeds itself. Workers lose income, consumers spend less, businesses earn less revenue, loan repayments get harder, more defaults happen, lenders become more cautious, refinancing dries up, more companies get trapped. That is how a credit problem slowly turns into a real economy problem. This is also why private credit is not just a rich people casino issue. If enough mid-sized businesses come under pressure at the same time, the pain does not stay in spreadsheets. It shows up in jobs, investment, confidence, and everyday economic activity. And yes, banks still matter here too. Even though private credit is often sold as outside the banking system is not completely outside it. The IMF warned in 2025 that U.S. banks have substantial undrawn commitments to private credit and private equity funds, and Reuters reported that banks had almost $300 billion in loans outstanding to private credit providers as of June 2025, plus another $340 billion in unused lending commitments. So the firewall between banks and private credit is not exactly made of steel. It is more like a curtain with holes in it. Now, does this mean we are definitely getting another 2008? Not necessarily. History never repeats perfectly, but it absolutely loves to rhyme. Back then, the problem was housing debt wrapped in complexity and overconfidence. Today, the concern is private business lending wrapped in opacity, leverage, and the belief that sophisticated investors know what they are doing. Maybe they do, maybe they don't. But markets get fragile when everyone believes bad outcomes are unlikely, right up until the moment they arrive. And that is really the key point. Private credit is not evil. It can genuinely help businesses that banks no longer want to serve. It can provide flexibility. It can fund growth. It can fill a useful gap in the economy. But when too much money chases too few good deals, standards slip. When leverage stacks on leverage, risk multiplies. When investors want daily confidence from assets that are fundamentally illiquid, trouble starts. And when the same system depends on constant refinancing, rising valuations, and fresh money coming in, it starts to look less like smart finance and more like a very expensive game of musical chairs. So the big question is not whether private credit can work. The big question is what happens when it stops working smoothly. Because if a major correction hits a market this large, tied so closely to real businesses and partly connected back into banks, the fallout could be messy, political, and painfully real. And unlike 2008, governments today are dealing with heavier debt loads, inflation sensitivity, and a lot less public patience for rescuing powerful financial players. So yes, this is a story worth watching very closely. Private credit may not be the next crisis, but it is definitely one of the biggest hidden fault lines in modern finance. And in markets, the things people ignore for the longest often become the things they panic about the fastest. If you enjoyed this video, hit like, share it with someone who wants to understand how money really moves, and subscribe for more easy-to-understand finance content. Keep learning from Economy Quotient.